Appreciate everyone that was able to make the call today. And today we've got Will Price of Next Frontier Capital. But before we get started here, I just wanted to reach out and thank Rick Rep and Witherspoon Kelly for sponsoring this. I think most people on the call here are well aware of Rick, and he's kind of the go-to person in the region for securities related legal matters, starting companies, angel financing, venture financing, and merger and acquisition work. Rick, I don't know if you wanted to say anything before we get kicked off here.
I just want to say welcome to Will, and thanks for providing this presentation. We definitely appreciate the insights from investors outside our market, and hopefully you'll take a greater interest in our market.
Thanks, Rick.
And I am hopeful that the kind of part of this dialogue, we are able to maybe elicit some questions from Will about what's going on in our region and some of the more notable companies, and how we can leverage his expertise in bringing so much capital into Montana, into our area. So this might be a little different than some of the other presentations in that it's kind of a two-way learning street.
Perfect.
But I think let's go ahead and get started. And today we're just going to have an interactive conversation. And really, I'm just going to start off, Will. I know you gave us a thumbnail sketch of your background when we had a small group on the phone a few minutes ago. But if I could ask you to kind of repeat, what you did before you became a venture capitalist.
Sure. Yeah. First of all, thanks so much for having me. I recognize a good friend in the audience. Steve Rector and I have gotten to know each other pretty well over the last 6 years, and I've been to Spokane, and really enjoy your market. Love to do more there. So let me start off by saying that my first job in venture capital was with Pequot Capital Management in around 2000. Pequot was a multi-strategy hedge fund at the time, and it was a little bit what like Blackstone and KKR and Apollo have become now, which was essentially giving limited partners access to a variety of different strategies, whether it was long short equity, convertible, fixed income, quantitative investing. And they wanted to have a private equity practice. Before that, I'd been CEO of a really small startup. We got to about 12 people. We were acquired by one of Pequot's portfolio companies. And during the M&A process, they met me and they're like, well, what are you going to do now? And I said, I don't know. And they said, well, why don't you come help us think about how we make investments in California? So I worked in the Menlo Park office on famous Sand Hill Road for 3 years with them. Pequot was as a private equity group, about $2 billion organization, but they try to compete across a broad swath, all the way from early stage investing through pipes and public companies. And what I kind of felt was there wasn't enough focus on a specific type of company or a specific point of entry, which made the competition, the challenge of running up and down the seniority of these companies a little bit difficult to be successful at. So I went to a really early stage enterprise software VC called Hummer Winblad. Hummer was the first software-only venture firm. Mark Ornberg, who started Zeta Venture Partners, who Steve knows, came out of that organization as well. Hummer was a great place because, unlike Pequot that had such a wide aperture, it was very simple. What we woke up in the morning to try to do was B2B technology based in the Bay Area, two-handed Series A deals, 4-on-4, put in $2 million. And I really love that focus and that ability to do that. Probably the most notable investment that I worked on was MuleSource, that sold to Salesforce for $6 billion. It's the one company that I've worked on that has gone from literally two guys. It was called Zeki Software when we did it, to MuleSoft, and then bought by Salesforce. And it's been one of the most successful investments Salesforce has made. It was a middleware product that came out of the open source space. But I was telling Tom earlier, I'd be in a lot of these board meetings, and I'd be listening to difficult conversations around challenges companies were facing. And it always struck me that the people that had the most wisdom and didn't panic were the operators around the table, as opposed to the professional investors who went to maybe Stanford Business School and then immediately became venture capitalists. And there's a old conundrum in venture capital, which is it's something that it's a vocation you can learn from early age, or is it something you do once you've been successful as an operator? And of course, there's lots of examples of success of each camp. But for me, I really felt like the operators, especially in the early stage, brought the most empathy to the entrepreneurial process, the most relevant feedback and guidance. They were less surprised by setback, and challenge. They expected it versus being surprised by it. So at about 36 years old, I realized I kind of got my career backwards, and I'd gone into venture too early. So I left and became CEO of a busted portfolio company of ours. It was called Widgetbox at the time, and the other investor was Sequoia. Jim Getz, who went on to fame being the WhatsApp investor. And I ran that company for 6 years. We basically built products that would now be called like native advertisement products. The challenge at the time was if you were, let's say, golf.com or Business Week or any, you sold an audience essentially around a certain area of interest. And you used to be able to take a standard advertisement and charge $20 per CPM for that. But what Google and Facebook and others did was they could essentially deliver that same audience at a much lower price, maybe a tenth of the price. And so all these platforms really were being commoditized and their business models started going sideways. And so they needed a way to break the commoditization of advertising. So they started building ads that you couldn't buy elsewhere, that were unique to that platform, that were sourced or powered by content or videos that platform had. And that has now become known as native advertising. So that was our product. We supported them. We had, most of the publishers in the country used, and around the world too, used us. And that was eventually bought by Snapchat, and it's their self-service ad platform. So then I moved to Montana in 2014 and really thought I wanted to work on something that was additive to the community here, that was filling a missing need. And as I started meeting people in town, there was a lot of smart people, but there was no money. I mean, zero money, and very little interest in investing in the region. And so we started at the time, a $20 million fund was the goal. That's NFC Fund 1. It ended up being about 21 million. And we made 9 investments in Montana. We made 10 investments in total. And that's been a successful fund and became part of kind of making Missoula and Bozeman places where you could create startup companies and attract capital. The amount of capital in Montana from 95 to 2015, total venture dollars was $143 million over 20 years total. And since 2015, we started the fund, it's been over $600 million coming to Montana. So it's been, we got the timing right with COVID and the rise of the Rockies and all that stuff, but it really went from a desert where you just couldn't be taken seriously to a place where now we're able to see successful companies being put in the ground here. And I'll just keep going for a second. So NFC Fund 2 it's 38 million. We added Colorado as a specific area of focus, and we just closed NFC 3 last week, and it's basically a regional fund. So Spokane, Boise, down to Reno, Las Vegas, up, we do Arizona, Colorado, up through Utah, back to Montana. And so right now we've only invested in 3 states. We invested in Utah, Colorado, and Montana, but we're very interested in investing in Eastern Washington, in Idaho, and hope that we can find ways to work with you guys.
Excellent, excellent. Well, this is a good transition to kind of my next set of questions, which is, you talked about your geographic focus, but, what industries are you focused on? What stage, how much, all of those sort of things, lead and co-lead. And before you answer, I kind of want to remind everybody else that if you have a question, just send it to me in chat and I will call on you. We do want to make this interactive, but great background for you. But now tell us a bit about kind of what the centerpiece of your focus is at the front.
It's evolved, to be candid. So when we first started, we had a single state focus, a small state at that. So it's hard to be both sector focused and regionally focused. We only do software startups, in Montana. It's like you get a small amount. So in the first fund, we did a variety of different things. As we've expanded our geography, we've kind of collapsed back to some key focus areas. And so I would say our bread and butter investment would be a B2B SaaS business. That's something we wake up every day wanting to do. We've done some deep tech stuff like LiDAR systems for self-driving cars. We have an optical signal processing company. So, and we've done a few on the consumer side where Onyx Maps is probably the most famous company we've got, which if you're a hunter, you definitely use Onyx. It's a subscription app like a Garmin on your phone. But the bread and butter for us is really B2B. And in terms of point of entry, we've learned the hard way about that too. we try to invest in 2 stages, and those 2 stages are defined where it's been typically hard for people to raise money in the region. One is when you're pre-Series A, so you're not yet ready for like the major national firms. That tends to be sub 1 million in revenue annually, like let's say, $250,000 to $500,000 a year in revenue. And then interestingly, what we found, Tom, in our second fund was there's a second hole in the market in the Rockies, which is that most major firms today, if you look at Lightspeed, Greylock, Sequoia, Redpoint, Excel, they have 2 practices: early stage and growth. And so early stage is looking to be the first major shareholder at around the 1 to 2 million in revenue stage. And then the growth is looking for 10 plus million in revenue that can consume 25 to 100 million of paid in capital. What we found then is that if you're a $3, $4, $5, $6 million ARR business, there's really no one to go call on from a national firm perspective. If you go call on them and you say, hey, we're 5 million in revenue, we got a Series A investor already, the early stage team is like, oh, we missed it. And then the growth team is saying, come back when you're 10 million. So what we found in the last 18 months is that we now have 2 points of entry. One is that pre-A, 25 to 75,000 bucks a month in revenue. And the other one is the post-A, but the pre-growth. And we've been led to that, not so much by skill set or that's where we want to invest. It just turns out those are the hardest rounds to get done right now in the Rockies from our perspective. And so we just try to lean into where the entrepreneurs and the boards are having a hard time. You avoid commoditization, obviously. You avoid having to bid for deals that are super competitive. But it's been a good strategy for us. So,
Do you have a name for that post-A pre-growth?
we call them, it's a terrible name, but we call them tweeners. So we did a bunch of deals last year. Bonusly, Everyone's Social, Claravine, a bunch of companies in that space that are in the 4 to 6 million ARR space. And the reason I came on it was we had 2 companies in Montana, one called Quick, one called Submittable. And they were really good companies. One was about 3 million, one was about 8 million in ARR. And we went out to raise and we couldn't get anyone interested in them. And I was like, what's going on here? Like, is this a regional bias? Like, is it, the presentation's not any good? And then I was able to kind of do some homework on it. And they were like, well, we have an early stage team and a growth team, and these are neither fish nor fowl. They don't fit into the model. And all of a sudden I started thinking, oh, that's interesting. Like, maybe I can play that as a sourcing game, like go find deals that look like that. And sure enough, that is a really hard round to get done in the Rockies. 4 million in ARR, 5 million in ARR, quarters that are a little bit like this. You haven't got perfect metrics yet. You're still trying to work things out. The growth guys are really looking for incredible predictive revenue, high growth, and they're willing to pay through the nose for that, but they don't want to do the work for stuff that's not at scale or just still variable in its metrics. So, and then in terms of how much we invest, we really have kind of 2 positions. We're totally open to syndication. So we're not at all like, if we don't lead, we don't want to do it. Like, I'm very comfortable being a syndicate partner. And we basically think of 2 things. If we're going to lead, we want to own around 13%, and if we want to follow, we want to own around 5%, and the size of check is kind of derivative of those 2 goals. It used to be that, the cliche in venture was you want to own 20%, right? But owning 20% either means you put a lot of money at risk or you go super early. And it just turns out that it's not really a practical reality to get to 20% anymore. I mean, for us, I haven't seen it. So if we end up at 13 to 14, 15% as a lead, that's our kind of target. And then we struggle to go below 5% as a co-investor.
Okay. And per fund, how many investments are you looking to make?
That's a good question. So the first one was 10, that was 21 million. The second fund was 38 million. We did 16 investments, and this fund is 80, and we've got 9 already. And I think we end up with 27, something like that.
Okay. So you've already made 9 investments from the most latest fund?
Yeah, the way it works when you're not, world famous venture firm is you have the first close and you have a year to continue your fundraise. So we were able to both raise and invest along the way. So that last close last week was that 12-month, time period expiring. So.
Excellent. Now, on your website, one of the things that you say that you're focused on is mission-driven entrepreneurs. What do you mean by that?
Yeah, so to me, it's born out of my own personal experience. So I ran an ad tech company, like I said earlier. I had no interest in ad tech. I mean, I don't care about ad tech. And so it was really like a almost like being a mercenary. It's like, I want to make the most of this company, but my motivations were trying to make money for my investors, take care of the employees. But it's not like we were curing cancer or doing anything that I thought was going to make the world better. And so when you run into hardship, when you're not mission driven, you have very negative motivations to continue. It's like, well, I don't want to fail. I don't let people down. I feel responsible to my investors. I want to make sure the employees are taken care of. Those motivations will get you out of bed in the morning, but it's not it's not going to make you run through a wall. Like, if you feel like what you're working on needs to happen, when you run into hardship, you just have to go back to first principles and be like, well, why are we doing this? Well, the world needs this. It's going to be better. We're going to change things for the better. And so to me, I like being around entrepreneurs that are doing things, you're sure they want to make money, but like, it's that they really believe fundamentally that what they're working on is important. And I saw someone said once, the purity motivation is the number one predictor of success. And startups are really hard. And when you get kicked in the teeth and if you're not truly inspired by what you're doing, I think you're going to struggle to be at your best. So for me, mission ties to passion, ties to energy, ties to grit, and being able to stick it out. And then you can rally a team around mission too. Like, I was once asked a question like, what's your unfair advantage with respect to access to talent as a CEO? And it's hard in ad tech to be like, well, we're going to sell more Cheerios or Mercedes Benzes. Like that's not necessarily the best. But the best, well, I said, well, what do you mean? He goes, well, SpaceX, like the Caltech PhDs will work for 80 grand a year because they put rockets in space every quarter. That comes back to mission. It's like, you get better talent, you get better commitment, and you get greater staying power. So long answer, but that's what we mean by that.
Love it. Can you give us an example of a mission-driven entrepreneur or a company in your existing portfolio?
Yeah, so we have Onyx Maps, I think is a good one. Like Eric Siegfried started Onyx. Why did he start it? He's a public land hunter. Couldn't work out where to hunt. There's all this checkerboarding in the Rocky Mountain West. It's a passion for him. He built a GPS chip that went in his Garmin so he could, be out in the field and be like, all right, I'm now on public. Well, I got to stay here, or I can get access to some public land if I go this way, or I can call this landowner, ask for access. And so Eric started that out of a personal problem that he had. Turns out like a lot of people have that problem, and this is now a $40 million business for roughly in terms of revenue. So that's a good example, I think. We have another company, Site One Therapeutics, which is it's our only drug development company we've done, which is working on non-opioid pain medication. So how do you treat chronic pain without leading to addiction, substance abuse, and that to me, like if we can solve pain treatment without creating addicts as a byproduct, that would be a huge outcome for us. So those are two examples.
Okay. Well, I can relate. I mean, particularly in this effervescent market right now, you sometimes get entrepreneurs coming to you and say, hey, guess what? We're going to go public in 6 months or a year.
Right.
And thinking that I'm really going to be impressed by that. And I go, really? You're going to go public? And they go, yeah. I go, well, I'm probably not interested in that. If that's your only objective,
I know.
That's not sufficiently meaningful to me.
And I love the founding story. Like, why are you doing this? Like, life's short and life's hard. Like, what's the point? What? Tell me a little bit about where this idea comes from and why it's important to you. And so,
yeah, you want to see someone with just a burning passion for what they're doing. And I kind of think about, Howard Schultz when he started Starbucks, or Phil Knight when he started Nike, or Gates and Allen and Microsoft. They were out there to change the world with something that they were such strong believers in. And you just knew they were going to work 24/7 through thick and thin to make it happen. And that's
right. That's right.
Hey, so you mentioned like Site One Therapeutics, which kind of prompted me. Spokane has 2 medical schools now. We produce more medical students in Spokane than we do in Seattle. Is healthcare or life sciences at all in your focus?
Healthcare is for sure. Healthcare tech, life sciences. We've decided not to do any more therapeutics for I think good reasons. We don't know anything about it. When you're in a board meeting Googling acronyms, like it's not a good thing. So we did do one biotech investment. We won't do more, but we have several health tech investments that are focused on, reducing costs and improving patient outcomes using software. And so health tech for sure. Like, I think that, probably the largest unsolved problem in our country is medical, how we deliver medical care, how we pay for it. And so, 17, 20, trillion-dollar market, whatever it is, or, it's a big part of our future is to solve that. So we would definitely be interested in med tech, but we're not doing drug development.
Okay, well, I can relate to that. Spokane does have a number of health tech companies. In fact, we have some representatives on the call here today. We have Gestalt Diagnostics, run by Dan Rourke, working in digital pathology. GenPrime, that has some also unique testing applications. MedCurity, that's working in HIPAA compliance. So Spokane really does kind of have a concentration in health tech. So hopefully there might be some opportunities in that area that we
I just put my email in the chat to everybody, so feel free to email me anytime.
Excellent. So, one thing, you in some ways, what you have done is really a model for us in our region. And, some of the things that you or your partners have worked on is 406 Labs, an incubator or accelerator, and the tech park that you have. Can you talk a little bit about that and perhaps how also that is contributed to an increase in the formation of companies in Montana and, the dramatic increase of dollars flowing into the state?
Yeah, sure. So we have a tech park that's on at MSU. It's 42 acres that is currently being developed. We have one building on it right now. It's a secure SCIF to allow for essentially highly classified research work to occur. MSU professors couldn't take research grants from the government at a certain level of security clearance because we didn't have a building that was secure enough. So that was the goal of that building, which MSU is a relatively small research university. It's about 160 million a year, but we felt like we could double the amount of research we get if we were eligible for that DARPA money, and so that's the driver behind that. When the reality, I think right now is that the universities are not driving company formation the way you would think. Almost everything that we do comes out of the private sector. We have 3 companies out of 35 that come out of universities. So it's like 10% of our business. When I went down to Boulder and met with the Access Venture guys and the Foundry team and Boulder Ventures, and you ask them, like, how important has UC Boulder been to you as a source of ideas? I think, it would probably be a similar percentage, very small percentage. And so most of the focus for us has really been about private company formation, whether it's the IP transfer office or the, frankly, even like there's a pejorative view on our campuses about professors starting companies and taking time away from research and teaching, actually build businesses. And so it's not something yet that's culturally accepted, I don't think, at the university level the way it should be. The universities are trying harder to make it easy to license technology and work on it. But there's also a challenge with public owned facilities where you really can't even use your own lab to do commercial work. So you have to either set up a parallel lab or you've got to find money to pay the university for access to your lab to do the work you're doing. So long-winded with saying is we spend a lot of time with universities. I know the heads of research at universities here, but it's not a material factor for our business. Our business right now is really being a function of entrepreneurs choosing to, at least some of the team, to live and work in our region. And the exciting thing I think that's happened since COVID is we used to spend a lot of time thinking, how are we going to get Facebook or Google or Salesforce or Twitter or somebody to open office in our region? What's it going to take from a tax subsidy perspective, facilities, infrastructure, flights, whatever. The best thing about COVID has been all those companies have opened offices, and they're not official offices here. They're just their employees have moved here, And so what that's done for us is we think about being regional, and when you define a regional strategy in a world where there's companies that are distributed, all of a sudden it's it doesn't make sense anymore. The old model of headquarters is no longer really the relevant metric. So what we do now is is there a senior founder or executive in our region, even if the company is distributed, that counts to us as someone we'd want to invest in because they're going to eventually build people around them. And so to us, the biggest driver hasn't been the universities, to sum up, I guess. We get some talent out of them, no doubt about it, as employees. But the founders are either coming out of companies that are in the region, like that have been successful, like right now, obviously, or more importantly, now it's these refugees or migrants that are coming in that are part of a national company that one of them wants to live here and be here. And that's really been more important to us than the universities.
When you started your first fund, were you surprised that you were able to identify enough compelling investments in Montana?
Yeah, certainly the big question, which was like, are there deals here? Could you get them done? And if you could get them done, would anyone want to invest in them? And then would anyone want to buy them? Those are the three big questions. The way I kind of solved for that in the fundraising process for Fund One is I did a bunch of SurveyMonkey surveys to investors and to corp dev executives, basically asking like, are you more or less likely to invest outside of California in the next year? And if you're more likely, what type of companies are you interested in? What scale those companies need to be? And what I started seeing in the data was a trend where, especially younger partners, it was so competitive in the Bay Area in particular, that in order for them to win, they had to start being a little more creative. And so there seemed to be a greater willingness to get on an airplane and do business that way. And then in terms of Montana, I wasn't as scientific. I just met with a bunch of people like before we started the fund. And I was like, okay, I probably met with like 10 companies that would be funded if they were somewhere else. They happen to be here and they're not funded. And then the real challenge was, are they so wedded to the STTR research grant process that they're just going to stay on the random walk of whatever government's willing to fund and never become customer centric, never ship a product? Or were these real product companies that would, wean themselves off government funding and go do stuff? And I just got comfortable that there was at least, 10. That's what we ended up doing. The first fund was about 10 companies. So, but it was definitely, raising a fund for, in Montana was certainly not easy. And what the way it happened essentially was you just go, okay, well, who cares about, it has to be people that know Montana, that have money.
Yep.
And so what I ended up doing literally was like go on like the Montana Land Reliance Board, the Nature Conservancy Board, find all these nonprofits that were focused on the state and just look at their board of directors and be like, oh, that person looks like they have a lot of money and they care about Montana. That's how we got the fund raised. Since then, it's got a little easier to raise money, but you're absolutely right. At the time, it felt like it could be a daunting lift to get it going.
Yep. So what are some of because we get a lot of that in our region when we're fundraising for companies, in Spokane, Coeur d'Alene, or Sandpoint, the obstacles about being outside of the Bay Area or one of the other tech centers. Do you see those objections decreasing? And what are some of the common ones, and how do you mitigate them?
Yeah, it was interesting. Like, I feel like if you think about like there's entrepreneurs, then there's investors, and there's limited partners. The entrepreneurs are always the closest to the truth, right? Like, and so I would say I take a lot of comfort knowing that there's a lot of entrepreneurs that are moving here that are really bona fide, good, qualified people, right? And so that gives me a lot of comfort. The investors are starting to pay attention to the fact that, innovation's being more distributed, that companies are being more successful. And some of their, challenges are really around hiring volume, and then sometimes it was like, all right, well, I'm not sure anyone's going to want to buy a company in Sandpoint, and then set up an office there. So like, is M&A going to be compromised by it? Like for now, what I'm seeing is that our companies are hiring independent of location now. So because of distributed workforce, like the core team may be here in our region, but we're hiring people all over the country or even internationally. And so that kind of access to talent question seems to be a little bit mute. And on the acquisition front, that one doesn't seem to be a big stop. We've had, 5 exits so far. The one group that I find is really behind the times and very difficult to get them to take the regional investing seriously is limited partners, like institutional limited partners. I mean, their view basically is like, hey, California is 50% of the venture economy. It's like 70% of the return. So if you're going to take out that whole option to invest in California, is it even worth being in the asset class? Like, and that's been the hardest one for us to overcome. And candidly, between us, like, all our funds are basically high net worth family office. We have a little bit of money from institutions, but that's been a really difficult challenge to get institutions to believe in this thesis.
Yep. We're starting to get some questions in here. We have one from Katrina Rogers, kind of back to the observation you were making about universities. Katrina?
Absolutely. Hey, thanks, Will. It's been a super interesting conversation so far. Wondering, you make a good mention about the lack of cultural acceptance in universities, and I'm wondering what university incubators can do to either change that lack of cultural acceptance or to modify it.
Yeah. I think the best thing that happened is honestly, if you look at the Stanford model, it feels like to me it's the postdocs and the PhD students that end up running the companies, and the professors remain as tenured professors. So part of it is not really thinking of the model, all right, tenured professor is going to leave the university and go start a company. I mean, if you look at Akamai or Cisco or so many of these great companies, the VMware is a good example. They actually never left academia, the founders, right? There's an innovation that happens, but they have PhD students that decide they don't want to be professors. They want to apply their innovation in some way. And so to me, it's really a focus on the graduate student, I think, as opposed to the professor. You want professors to think about creating companies and be incented to create companies, but the ask shouldn't be, oh, by the way, we want you to give up your job and go take this big risk. So de-risk it for the professor, really identify the graduate students that are more entrepreneurial than they are professorial, if you will. And then make it easy for that IP to come out of the university with some royalty that's not, and most universities I think are getting better at the IP transfer part. And then I think honestly, if you have a couple examples of some professors making real money, that can change things fast too, because you're like, well, I'm smarter than that guy or that woman. That guy's just driving around in a brand new Tesla and it made a lot of money. So one of the things that I look at is how many graduate students are there in a particular lab, and how many of them want to work in academia versus go work in the commercial space. And I think if you look at the Stanford example, like Jerry Yang, David Filo, Yahoo, grad students, Larry and Sergey were grad students, it is the grad student, not the professor, that becomes the actual not founder, but employee, if you will, of the company. So.
Katrina, I think another
Great, thank you.
Another observation I might have to your question is, I think it also takes a really solid director of commercialization, someone that understands startups, understands capital formation, and can speak to academics about whatever they're developing, how it needs to have a meaningful commercial application, and help guide and direct the grad students and the professors in that direction. And then also be able to break down all the barriers within a university to even make it happen. And a great example is there's a gal in Seattle, Lyndon Rhodes, several years ago, who kind of took over that commercialization role. She's no longer there now, but she just made tremendous changes and just pivoting the culture to really develop ideas that have commercial applications and then get them to market as efficiently as possible. And universities, unfortunately, tend to hire heads of commercialization that are academics themselves, and that's not terribly effective. But we have a question here from Chris Bleasner, who I think, Will, you might know. Chris is kind of one of Spokane's more successful serial entrepreneurs. He had a company called Second Watch that he started, grew successfully, and now he's started a new company called Vega. Chris, fire away.
Great. Hi, Will. Thanks for being here. So we think remote working is pretty important, and part of what we're trying to get our brain around is sort of your thoughts around how long this is going to be a focus area for both corporations and startups in terms of supporting and enabling it. And then when all is said and done, so sort of a two-parter, when all is said and done, what do you think the percentage of employees that will be that are still working primarily remotely?
Yeah, it's a great question, Chris. And, I've been doing some, I would say, anecdotal, but significant attempt to understand this. So we created a Slack channel for Bozeman in the last year. And we just have all, like, we invited anyone in the tech community in Bozeman to join the Slack channel, and literally like blew my mind how many people were working remotely that were in Bozeman. Like, like I said before, Stripe, Salesforce, Google, Facebook, Twitter, so many great companies. And I've been getting to know them on Slack, and I've asked them all, like a lot of them, the same question, which is, what happens when your boss says it's time to come back? And here's what I think at least half don't go back. And they bought homes here, their kids are in school here. They can't imagine. I was talking earlier to Tracy about about going back to San Francisco. They can't imagine moving back to San Francisco. And Google, I think, is fascinating in particular. So I've used Google as a case study. So Google said they want you back September 1st. So you're Google, game theory is happening. You're hyper competitive market for talent. You're a good engineer, and you say Google says come back, and you're like, no, I'm not going back. Right now, in order to stay in Bozeman, it has to go to the SVP of the ads team to sign off on you staying in Bozeman. And so the way they tend to done that is like, they don't want anyone to ask, because it's got to go to like Ashok or whatever the guy's name is, right? Like no one wants to do that. So that person is probably going to start interviewing, and they're going to call the people that have said, hey, you can be distributed as long as you want. And that includes Twitter and Stripe and Square and Salesforce, and Microsoft even is talking about it. And they're going to call up Google and say, on August 15th, I'm not coming back. I just took a job at Stripe. And then Google's going to get a bunch of data back and be like, we just had 20% attrition of our best people. I guess we should probably not have them all come back. And I think it's going to just play out that way. And the other thing that they're trying to do now too is they're saying the cost of living adjustment. All right, you're not coming back. We're going to pay you 85% of what you used to get paid. And I think it's going to backfire too, because people are like, well, I'm going to go work at Stripe then, because they're going to pay me 120% of what I used to get paid. And that's going to start playing out too. So I think at the end of the day, you end up with a really distributed workforce where maybe you fly to quarterly kickoffs at a hotel conference for 2 days. Everyone says hi to each other, and then you go back. So I guess to answer your question, I think 50% is my guess. And I think it's exciting, because I think it's better for all of the small regions that we operate in, if people are going to be able to have opportunity for income growth and success, to be independent of location and choose where they want to live and still have access to that. I mean, we used to joke in Montana, we call it the Montana discount, right? It's like, you got to find a job. Most jobs aren't very good, but now it's like, hey, it doesn't matter. And so anyway, that's my view on it. I'm essentially betting on it in some sense, but that's based on like scores of conversations I've had with people that are facing that choice later this summer to go back or not go back.
Good. Thanks, Chris. Heather with Drip 7, you have a question?
I do. Well, first of all, Will, thanks. Wealth of information. And what I see is you're really trying to add diversity to where people can invest, right? They can invest in Montana or any other place that has good founders and entrepreneurs. And I'm just wondering, do you see a shift in people opening kind of their ideas and thinking, hey, maybe there's different types of diversity that we can add into this, not just geographical diversity?
No question about it. It's a great question. I mean, I'm on the board right now of the NVCA, and it's been the #1 topic in the industry, because the venture industry is a pathetic industry when it comes to diversity and inclusion, right? It's like probably one of the worst, if not the worst. And so it's been a huge topic, I think, for people, recognizing how little money goes to female founders, how little money goes to people of color as founders outside of, Indians and Chinese, and so rethinking what fairness and inclusion means, and diversity. And so, I worked for Ann Winblad for a while. She's, I would say the industry from 87 when she started to 2007 didn't change at all. Like, it was as bad as it ever was. And then right around the Me Too movement, you started seeing some change, and you started seeing, people actively looking to hire. And now if you look at, you go to the venture pages and you look at the teams, they're much more representative than they've ever been. So I think it's an absolutely top of funnel concern for everybody. And I would also say that I understand now that limited partners are really driving it as well. Like, if you go to raise money and you have all white guys on your team, for example, like, your chances of getting funding go down. And the reason I think that's important is that until the actual venture firms change their representation, I'm not sure there'll be a lot of change in who they fund. And so it's really about breaking into the venture market, making sure there's more women in charge of venture decisions, more people of color in charge. And so, what I try to tell people, because this goes back to the regional argument, I say, look, gender and ethnic diversity are absolutely fundamentally important, but so is geographic diversity. Like, we just can't keep pouring money in the same markets. So to your point, diversity as a theme is something that's happening for sure. And I think a lot of limited partners are making, on the margin, they have got their existing relationships, but if they're making new manager decisions, the criteria for that new manager does include diversity of team, or, and I think it'll change behavior.
Great, thank you.
And Heather runs a startup in Spokane that's getting a lot of traction called Drip 7,
Cool.
focused on micro learning initially for cybersecurity.
Yes, so tech, being a tech founder in cybersecurity and being female is and not being in Silicon Valley is
Triple whammy.
Yeah, triple whammy. So
That's cool. I'm looking on your website now. I'll check it out. Thank you.
sounds great.
Yeah.
And then Chris, you've got a question?
Yeah, so
thanks, Will.
just back to Heather real fast. Heather, we had an investment called the Tata that was sold to Mimecast, which was in the training space. It was the whole idea was like, hey, you can put all the security you want, but if your people aren't trained, then it doesn't matter. So Mimecast ended up buying them a couple of years ago, but so I like this space. Yeah.
Good. We might be hearing from Heather then.
Cool. Yeah. Sorry to interrupt.
No. Chris, you had a question?
Yeah, no problem at all. Yeah, thanks, Will. This has been super interesting, and especially considering your more rural focus, and especially software focus. I'm just curious about what you're hearing in terms of Starlink and other initiatives to get broadband access to more rural areas, and how much you see that impacting your portfolio companies or the communities that you're trying to serve, and so forth.
That's a great question. Starlink's, huge. For people who don't know, that's Elon Musk's new business. I mean, I don't know, the guy knows to never sleep, but yeah, this is these micro satellites, low orbit, that can generate, I think it's 100 megs down. And the other thing too, by the way, is like the stimulus money, no matter where you sit on the political side of the equation, it's coming, and it's going to be a lot of money is going to go into rural broadband. And so I do think there's still real barriers to where people can work effectively in a Zoom world. If you can't do a video conference, like, it's going to be hard for you to be successful. So it's not so much an issue for us in Bozeman necessarily. We've got a fiber ring downtown, but I lived 10 miles out of Bozeman before the fire, and I used microwave terrestrial wireless, and if it rained or something, it's like, it would go down. So I definitely think Starlink, and we'll see how effectively and how quickly this money gets spent on rural broadband hookups, but I definitely think that could play a big role in making more people eligible to be able to do their work from home. So.
Great. Thank you.
Hey, well, great questions. Keep them coming. We've got another 15 minutes here or so. Hey, back to Montana, are the companies that are starting there or moving there, are they geographically concentrated in Bozeman, or are they dispersed throughout the state? That's part A to the question. Part B is Montana or Bozeman or Missoula. Are they putting efforts on outbound marketing and recruiting to get the word out and to try to recruit companies into the state?
Yeah. So first of all, in Montana, it's really in two cities. It's in Bozeman and Missoula. So there's people living in Whitefish, a lot of money in Whitefish, and there's some companies up there, but you can't really point to a theme of recurring success. But Whitefish, I think, is something to watch as well. Yeah, I'd say it's all in Bozeman and Missoula. Like Billings, I don't think there's much going on there. And outside of Billings, Missoula, Whitefish, there's not, Helena, I guess, but there's not much there. So it really is in these two university towns. Montana is an interesting place because it's definitely, and I spent a lot of time in Helena with the legislature. There are definitely a kind of libertarian perspective. So when you start talking about subsidies or recruiting or whatever, they look at you like, why would we do that? Like, we don't want to to pick winners. We don't want to take public
Yep.
resources and give them to private companies. And so it used to bother me a little bit. I used to say like, come on guys, like let's work harder here. Like, you know, my dad's family's from Montana. A lot of generations of people here, they all went to the military. There were no jobs. It was a difficult place. Like we can work harder to create economic opportunity here. I've actually come back full, you know, not full circle, but I've gone 100 degrees on that. Like, it's like Montana's political perspective is, this is a great place to live. Do you want to come here and work? Great. If not, we don't give a shit. You know, basically that's what I think is the truth in Helena. And then the truth is, by the way, Bozeman and Missoula are doing fine. The rest of the state is a shit show. So like, to the extent we have any dollars, they're not going to Bozeman, Missoula anyway, right? So they're going to go to, you know, deal with this, like a coal strip where the power plants are being turned off and people, 1,000 people are going to lose their jobs, or like, you know, the cattle industry is starting to really suffer. And so it's not a feed the winners mentality. Like, you know, you think about investing, it's like, take your best companies, give them more resources.
Yep.
The Montana perspective is the exact opposite, which is like, don't feed the winners. The winners are fine. Let's take care of the rest of the state. And by the way, if no one wants to move here and open a business up, that's fine with us too. So it's nothing to do with like top-down political growth. It's really organic. We have a new governor, Gianforte. He's a right now founder, tech, you know, centimillionaire. He has this theme called Come Back Montana. He wants to, you know, I think what he's going to focus on is tax rate liberalization as opposed to like specific industry focus. So our tax rates now are, I think we're at basically 6.9% is our top rate. And he looks, you know, you look obviously where you guys are, to Wyoming, to Colorado and Utah. He's going to try to bring down the tax rates and bring more people into the state who have wealth and make it a more attractive place to invest. So I think they're going to look at tax policy as the way to attract people, but not subsidies, not supporting, like say, the movie industry or the software industry and giving them preferential treatment. So long answer, but the answer is it's a libertarian state and they don't want to play an economic policy role, I don't think.
So if shows like Big Sky or Yellowstone helped or hurt your efforts?
They've definitely helped. I mean, look, I would say the number one thing, this is a big statement, I would say the number one thing that's helped Bozeman is the Yellowstone Club, which for people who don't know is like where Zuckerberg, Gates, and you know, the billionaires of the country come and hang out and ski. They all land in Bozeman. They all drive through Bozeman. They all go up to the, you know, up to the Big Sky. And there's definitely a segment of them probably never know they're in Montana, right? They get off their plane, get in a helicopter, go up there. But what we're really seeing now is that a lot of that money is starting to flow out of Big Sky and going into, and so it's been organic, but we've been lucky to have a lot of the really wealthy people start hanging out here and then wanting to make investments here as well. So
well, it's a very cool area. Question from Rick Rep. Rick, fire away.
So Will, you've mentioned the fact that the key to your fundraising money was people that were focused on Montana and wanting to see Montana grow. That seems to be your passion as well. But you also indicated you're looking at companies out throughout the Rockies. Can you give us an example of an investment you made outside of Montana and why, and what the profile looked like in a situation where you did invest outside of Montana? And how did you convince your Montana focused investors that was the right move?
That's a great question, and it's a really insightful one too. So, you know, the number one thing that people have warned me about running a fund is strategy drift and getting too big too fast. Like those are the two ways to blow yourself up and to lose your identity and lose money. And so, it was early on. I was very focused on we invest in Montana. We made an investment in Fund One that had an office in Boulder, so I started going down to Boulder to hang out with them, and I realized at the time, the biggest seed fund in Boulder was a $10 million fund called Blue Note Ventures. There was Access Venture Partners, there was Boulder Ventures, there was Foundry Group, but they were all hundreds of millions of dollars under management. They weren't really doing seed. So I thought, I basically started educating my LPs to say, hey, I think there's an opportunity in Boulder specifically and in Denver. It's undercapitalized relative to our area of focus. I'd like the permission to begin to spend time there. You know, I have the discretion to do it, but I obviously want them to support it. And so the second fund was formally had added Colorado to its mandate, and we've made maybe 10 investments in Colorado. The last investment in Fund Two was in Utah, and it was the same idea. It was like, how do we get into Utah? And Utah was a little more complicated because Utah is a great market, but it's a very competitive market, particularly at seed. You can't make the case credibly to say to your LPs, like, there's a hole in the market there, we're going to go and fill it the way we could in Colorado. So early on, I talked about those tweeners. I don't know if that was, yeah. And that's what we've been doing in Utah. So we've been sitting behind these Series A firms down there, like after Kickstart Invest or Epic or Pelion or Album, and helping them get that next round done. And so be a friend to the local community as opposed to a competitor. Don't be a carpetbagger, show up with sharp elbows. Try to be, be respectful of the people that got there before us. And so we've now got 6 companies in Utah. So you're absolutely right. I've been very Montana centric today, but each fund has formally included in its PPM the progressively, like, so fund 1 was Montana, fund 2 was Montana, Colorado, fund 3 was Montana, Colorado, Utah, Eastern Washington, Idaho. And so the LPs have bought into that, but within that fund, we don't stray. So like, we're just going to stay in our lane, but each fund we ask for permission if we can make the logic case to expand our footprint and our scope. I don't know where that goes next. I mean, I don't want to do deals in California, so this could be it in terms of scope, but it's kind of an organic thing where we see an opportunity, we try to process why this opportunity exists, why is the local market not covering it, do we think we can win and be competitive in that market, and then making a data-driven case to the LPs. And then through their fundraising commitments to us, they're basically giving us the blessing to do that. But between funds, we don't drift on strategy. And that's been a lesson from our LPAC, which is like, every fund that I lost money in, raised money to do strategy A, ended up doing strategy B. And not only did they lose my money, but I feel kind of misled, and don't fucking do that, like,
Yep.
pardon my French. And so we're very much not going to do that. So
when you're leading investments for companies based in Montana, how do you go about syndicating those? I mean, it sounds like you've had tremendous success in bringing in hundreds of millions of dollars into Montana since 2015. So how do you go about doing it? And then I'm going to kind of give a plug for my angel funds and the Spokane Angel Alliance. When you do have opportunities in Montana, please let us know, because Montana is within our geographic scope. But really, over the last 10 years, I personally have not made any investments in Montana. Done a handful in Seattle, some in Portland, a number in Seattle, but none in Montana. So I'd love to get added to your list.
Oh, please. Yeah, I'd love that too. And I would just say, honestly, I worked in the Bay Area for 15 years. And so probably the easiest explanation is to say, I know a lot of those people. And so, it's very easy to qualify. Like, there's definitely a set of people that are like, that I'm never doing that. Like Bay Area or bust, basically. But there's increasingly a number of people that, like I said before, either it's for competitive reasons. You look at the success of Zendesk or Service Target, not Service Target, ServiceNow in San Diego, High Alpha, Scott Dorsey's company, Exact Target out of Indianapolis. Like, there's just more and more examples of companies that broke out that are not in the and so I think the data has suggested that you can be successful investing out of there. So there's more willingness of the big firms. Like doing this 20 years ago would have been impossible, right? But today, I think there's more proclivity for people to believe that it can be done and want to do it. And they're willing to get on airplanes to do it, or Zoom calls, or whatever it is now. So when we syndicate, we're very much a collaborative firm. So we don't want to maximize ownership. Like, I'm a big believer that startups are hard. And when you're on your own, like, the weight of that responsibility, it's heavy to carry. And often the companies come back to you and they're like, well, we didn't get what we thought we were going to get. We're out of money. What do we want to do? I don't want to have that conversation by myself. Like, it's like, who else is around the table? What do we think about putting more money in? Do we want to put more money in? And obviously doing pro rata when you own 10% is a lot better than when you own 50%. So I'm a big believer in giving up ownership to build syndicates. And I think it's easier now than it's ever been. I wouldn't say it's super easy to get really good firms to start thinking about investing in this region. And we just make it a priority to early on, if we're the lead investor, identify a series of co-investors, give them all the diligence we've done, and then try to get them to make a decision. And then I'm also a big believer in doing referred deals too, because, reciprocity and building trust and getting to know one another is really important.
Yep.
So like if someone offers us a 5% position in the company and they've done the work on it, again, I like to do those too, because it's the game theory thing. Not only is that a good company, hopefully, but it's more likely that I'll be able to work with that firm over the next 10 years too. So really thinking about long-term relationships and just don't be a jerk, don't be someone that people go, oh, I don't want to work with that guy ever again. Like really spend time, even if it's not the greatest situation, try not to burn the bridges of the group that you're with.
Right. Well, I'd very much like to form that relationship with you and your fund and have a chance to look at some of your deals and participate in them, and then also have you look at ours. So
I'd love it. I mean, honestly, like, it's easy to say this thing, but I really do mean it. Like Spokane's absolutely in our region. We've done nothing in Washington State yet. If anyone on this call would like to work with us, I put my email in there. Tom's got my email. Steve Rector knows me pretty well too. If you want to reference, like, I would very much like to be considered for opportunities to invest there. And please do reach out on LinkedIn or otherwise. And I really appreciate the forum and the opportunity to meet a great group of people.
Well, thank you. And we're approaching 1 o'clock here, so we're going to be respectful of your time and everybody else's and conclude. But really appreciate you taking the time out today and learning about your fund. And I really am truly hopeful that this will kind of be open the door to more reciprocity and your firm looking at our opportunities and vice versa. And as part of that, we do have a gift for you. One of our leading consumer companies in Spokane is a company called Spiceology. They are nation's fastest growing spice company.
I know Chip, thanks to Steve Rector, I know Chip Overstreet fairly well. And I'd be glad to receive any gift from Spiceology that they're willing to share. So thank you.
Well, Cindy will be sending you a gift pack from Spiceology. And, again, if you're in Spokane or if you're in Sandpoint, let me know.
Cool.
I'd love to be able to continue this dialogue. Thank you, Steve Rector, for helping set this up. And then lastly, I want to remind everybody our next Meet the Investor is on May 5th. And we're featuring Aaron Richmond from Endeavor Capital, which is a private equity firm based out of Portland, but actively involved in the Northwest. So with that, thanks everybody. And thank you, Will.
See you guys. Take care.
Peace out.
Thanks, Will.